Safe investments with high returns. Maximize your wealth. Imagine this. You invest your hard-earned money, watch it grow steadily, and sleep peacefully at night knowing your wealth is safe. We're talking about safe investments that actually give you a solid return. None of that, oh, it's safe, but you'll barely beat inflation nonsense. In this video, I'm breaking down the best options available right now, step by step, so you can start putting your money to work for you. Let's dive in. Alright, let's start with the basics. High-yield savings accounts and certificates of deposit, or CDs. High-yield savings accounts are perfect for your emergency fund, short-term savings goals, or any cash you need to access quickly. With online banks, you can easily find rates above 4% APY, which is significantly higher than traditional brick-and-mortar banks. Now, CDs are where things get a little more interesting. They allow you to lock in your money for a set period, anywhere from a few months to several years, in exchange for a higher interest rate. The longer the term, the higher the potential return. And the best part? Both high-yield savings accounts and CDs are FDIC insured. That means your money is protected up to $250,000 per account per institution. So even if the bank goes belly up, your money is safe. They're not about getting rich quick, they're about protecting your money and earning a decent return while you do it. So, before you jump into riskier assets, make sure you have a solid foundation with high-yield savings accounts and CDs. Let's move on to another rock-solid option. Treasury Bonds and I-bonds. These are debt securities issued by the US government, and let me tell you, they're about as safe as it gets. When you buy a Treasury bond, you're essentially lending money to the government, and in return they promise to pay you back the principal plus interest. T-bonds are your classic long-term government bonds. They typically mature in 10 to 30 years, and they offer a fixed interest rate for the life of the bond. I-bonds, on the other hand, are designed to protect your savings from inflation. Their interest rate is adjusted every 6 months based on the current inflation rate. So, if inflation goes up, so does your interest rate. The beauty of both T-bonds and I-bonds is that they're backed by the full faith and credit of the US government. So when you invest in Treasury securities, you can sleep soundly knowing your money is as safe as it can be. Plus, they offer a predictable stream of income. This makes them a great option for retirees or anyone looking for a reliable source of income. So, if you're looking for a safe and stable investment that can help you preserve your capital and even outpace inflation, Treasury bonds and I-bonds are definitely worth considering. Now let's talk about dividend-paying stocks. These are shares of ownership in established companies that have a long history of paying out a portion of their profits to shareholders. Think of it like this. You become a part owner in a successful business, and as the business grows and generates more profits, you get a cut of those profits in the form of dividends. What's great about dividend stocks is that they offer both growth potential and passive income. Not only can the value of your shares appreciate over time, but you also receive regular dividend payments, typically quarterly. Many companies have been paying and increasing their dividends for decades, even during economic downturns. Think about companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble. By spreading your investments across a variety of dividend-paying stocks in different sectors, you can mitigate your risk and create a more stable and predictable income stream. A well-diversified dividend portfolio can provide you with a steady stream of passive income, often yielding between 3 to 5% annually, or even more. So if you're looking for a way to generate passive income and grow your wealth over the long term, dividend-paying stocks are definitely worth considering. Chapter 4, REITs, Investing in Real Estate Without the Hassle. Real estate has long been considered a solid investment, but let's face it, being a landlord isn't for everyone. That's where REITs come in. REIT stands for Real Estate Investment Trust, and they offer a fantastic way to invest in real estate without the headaches of property management. Essentially, REITs are companies that own and operate income-producing real estate properties. These properties can be anything from shopping malls and apartment buildings to office spaces, data centers, and even cell towers. When you invest in a REIT, you're buying shares of that company, which owns and manages a portfolio of real estate assets. The REIT then leases out these properties to tenants and collects rent. As a shareholder, you're entitled to a portion of the rental income generated by the REIT's properties. And here's the best part. REITs are legally required to distribute at least 90% of their taxable income to shareholders in the form of dividends. This makes them incredibly attractive for income investors. So, if you're looking for a way to add real estate exposure to your portfolio without the hassle of being a landlord, REITs are definitely worth considering. Chapter 5. Corporate and Municipal Bonds. Lending to big business and local governments. Let's move on to another asset class that often gets overlooked but can be a fantastic addition to a well-rounded portfolio: bonds. Essentially, bonds are debt securities. When you buy a bond, you're essentially lending money to the issuer, which could be a corporation, a municipality, or even the federal government. In return for lending your money, the issuer promises to pay you back the principal amount of the loan on a specific maturity date, along with periodic interest payments known as coupon payments. Now, there are two main types of bonds I want to focus on today: corporate bonds and municipal bonds. Corporate bonds, as the name suggests, are issued by corporations to raise capital. These bonds typically offer higher interest rates than government bonds because they carry a higher risk of default. Municipal bonds, or muni bonds, are issued by state and local governments to fund public projects such as building schools, roads, and hospitals. What's great about muni bonds is that the interest income they generate is often exempt from federal income tax and sometimes even state and local taxes. This makes them particularly attractive for investors in high tax brackets. Bonds issued by companies or municipalities with strong credit ratings are considered safer investments, but typically offer lower interest rates. Conversely, bonds issued by issuers with weaker credit ratings may offer higher interest rates to compensate for the increased risk of default. Remember, bonds provide a predictable stream of income and can help to reduce the overall volatility of your portfolio. Now, for those of you who are feeling a bit more adventurous and are looking for potentially higher returns, let's dive into the world of peer-to-peer lending and alternative investments. Peer-to-peer lending, or P2P lending, has gained significant popularity in recent years, and for good reason. It allows you to bypass traditional financial institutions and lend money directly to individuals or small businesses through online platforms like Lending Club and Prosper. Here's how it works. Borrowers apply for loans through these platforms, and investors like you can choose which loans to fund based on the borrower's creditworthiness, loan purpose, and interest rate offered. As an investor, you earn interest payments on the loans you fund, and the platform handles the loan servicing and collection process. P2P lending can offer attractive returns, often ranging from 8 to 12% or more, depending on the platform and the risk profile of the loans you choose. However, it's important to note that P2P lending does carry a higher risk than traditional investments like bonds or CDs. To mitigate this risk, it's crucial to diversify your investments across multiple loans. Don't put all your eggs in one basket. Now let's talk about alternative investments. These are investments that fall outside the traditional asset classes of stocks, bonds, and real estate. Some popular examples of alternative investments include farmland, precious metals like gold and silver, and even cryptocurrencies. It's crucial to do your research, understand the risks involved, and consider seeking advice from a qualified financial advisor before investing in alternative assets. Now that you know about some of the best safe investments out there, let's talk about how to really maximize your returns and supercharge your portfolio. These are the bonus strategies that most people don't know about, but they can make a huge difference in the long run. First up, diversification. Don't put all your money in one basket, no matter how safe you think that basket is. Instead, spread your investments across different asset classes like we've discussed today. High-yield savings accounts, bonds, REITs, dividend stocks, and even a small allocation to alternative investments if you're comfortable with the risk. Why is diversification so important? Because different asset classes tend to perform differently under different market conditions. By diversifying, you're essentially hedging your bets and reducing the overall risk of your portfolio. Next, let's talk about tax-advantaged accounts. These accounts, like Roth IRAs and 401ks, are designed to help you save for retirement and reduce your tax burden. By investing within these tax-advantaged accounts, you're essentially giving your investments a turbo boost. The less you pay in taxes, the more money you keep in your pocket to grow and compound over time. Speaking of compounding, let's talk about reinvesting your dividends and interest. When you reinvest your earnings, you're essentially buying more of the same asset, which generates even more earnings. Finally, let's talk about inflation. Even with safe investments, it's crucial to make sure your returns are outpacing inflation. So, there you have it. We've covered a lot of ground today, from the foundations of a secure portfolio with high-yield savings accounts and CDs, to the potential of dividend-paying stocks, REITs, and even alternative investments. Remember, building wealth doesn't have to be about taking unnecessary risks. By strategically choosing investments that align with your risk tolerance, time horizon, and financial goals, you can grow your money safely and securely. The key takeaway here is balance. You want a portfolio that provides both security and growth potential. The best time to start investing was yesterday. The second best time is today. Even small, consistent investments can add up to significant wealth over time, thanks to the power of compound growth. I hope this video has given you a better understanding of how to invest your money safely and effectively. Remember, knowledge is power, and the more you know about investing, the better equipped you'll be to make informed decisions and achieve your financial goals. If you found this video helpful, please give it a thumbs up, subscribe to the channel for more videos like this, and hit the notification bell so you don't miss any future uploads. Until next time, stay informed, invest wisely, and keep building that wealth.